Hello. In this video, we'll continue with our gross income problem set, and we're looking at problem 8. Now this one's a shorter one. Plum's employer sells her a computer with a $5,000 fair market value for $2,000 cash. So again, we're looking at whether this transaction is gross income. We're dealing with income taxes, and remember, whenever you have an income tax issue, always start by asking 5 questions. First, what amount of income, if any? What amount of deduction or credit, if any? So the income question, the first question being an inflow question, if there's any inflows, the deduction or credit being an outflow question. Then question 3 is who has to record the income or deduction credit? When is it recorded or deducted, or you get the credit? And finally, what is the character? Now again, we're focusing on gross income, so we're specifically focusing on what amount of gross income, if any, when is there gross income, and who has gross income. And remember that to define gross income for tax law purposes, under Code Section 61 of the Internal Revenue Code, gross income is defined as income from whatever source derived. So any income from whatever source derived. And again, we have the Glenshaw-Glass definition of income. Glenshaw-Glass, which basically states that in a more, because Section 61 is so broad, that gross income is an undeniable accession to wealth. So that's when net worth increases, and net worth is assets minus liabilities. When there is a realization event, legally severable. And finally, there is complete domain and control, which means there's no strings attached. So we're looking at this. Plum's employer sells her computer of a $5,000 fair market value for $2,000. So we're specifically looking at who? Plum. Does Plum have any gross income? Well, Plum is buying a computer that's worth $5,000 for $2,000. So you're probably saying, okay, well, Plum is purchasing, that's an outflow. So how could it be an inflow? And at first blush, you're right. How can this be gross income? Well, there's some important things to consider here. Whenever we deal with the concept of fair market value in the income tax law actually comes from the regulations in the estate and gift tax area, Reg 20.2031-1, and it states that fair market value is what a willing buyer and willing seller agree on, where the parties are arm's length. So we're saying that for tax purposes, this again is for the income tax definition of fair market value, when a willing buyer and willing seller agree. So it's not as simple as just, oh, okay, well, you look at the appraisal of what, if you're looking at a property and you use that appraisal. It's actually what the buyer and seller, so if they don't agree, if the buyer and the seller don't agree on an appraisal by some independent appraiser, then for tax purposes, it's whatever the buyer and seller agree if they're arm's length. But you're saying here, okay, we're dealing with fair market value, $5,000, right? And that's what Plum is getting, but Plum is getting the computer. So the value, this independent appraisal, let's say there's this computer is appraised by an independent appraiser at $5,000. But Plum's employer is selling it to Plum for $2,000. So you would say, okay, well, the fair market value seems like it's $2,000. But we have to worry about if the parties are arm's length, which means that these parties are not in any way related or have any type of influence. Well, we know there's an employer-employee relationship. And in tax, special relationships are a big deal. Special relationships, whenever you see an issue dealing with a special relationship, you should have like a red flag, like, like a siren, like an alarm, like, woo, woo, go off. Because there's a few special relationships you need to focus on. The first is when you have employer-employee relationships. Because there can be some implied transactions going on here. And I'll explain why, because here we have an employer-employee. Plum is the employee. Plum's employer is selling this computer. Another popular special relationship is family members, because there could be some type of gift relationship. Family members. And finally, another popular special relationship, and there's other ones, but these are really the big three when it comes to special relationships, is an owner of a business to the actual business. So really, what we're talking about here is if you are a shareholder in a corporation and you control the corporation, let's say you're a wholly owned shareholder, you're the only shareholder, you own 100% of the corporation, and there's some type of event going on between the corporation and that shareholder. And we know now, after watching these videos and from previous discussion, that corporations are separate from their owners, but for tax purposes, it is a special relationship. Now let's consider this employer-employee. Do you think this would really happen if these parties were unrelated? Would if party A, so let's take unrelated parties. So let's just say we have, a computer, Apple. Apple sells to a customer, and they're unrelated, a laptop. Let's just say a laptop, and the laptop is worth $5,000. Is Apple, which is very popular, going to sell to that customer that $5,000 laptop for $2,000? Well, generally speaking, holding aside discounts and coupons and credit and whatnot, let's just say just a retail, normal event where they don't have those special circumstances going on. Generally speaking, no, that's not the case. That's not what's going to happen. But with the related party, like an employer-employee, like we have here, you have this sale of the computer for $5,000, but it's actually being sold for a $3,000 discount. So there's a discount on that at $2,000. Now, if this was an unrelated party, that would be fine. There would be nothing to worry about when it comes to income. But this discount, this brings up a red flag because we have a special relationship. And the special relationship here is the employee performed services. So the IRS or Treasury would come in and say, this $3,000 discount is implied services. It's from the services of the employee during that year, and the employer saying, you know what, Plum, you did an excellent job. We're going to sell you a computer that's worth $5,000 for $2,000, and we're going to, in our minds, we're thinking, well, that discount, you earned it because you did the work. Well, we know that if Plum's employer instead changed their mind and said, instead of selling a computer, said, you did a great job, let's give you a $3,000 bonus, that would obviously be gross income. So what's happening here is the IRS, the Treasury is coming in saying, that $3,000 imputed service, that takes the place, that meets all criteria. That's as if it was a $3,000 compensation paid or bonus, which would be net worth. It's an imputed compensation. It's imputed compensation. It's realized because it's from the service, right? Services are always realization. And to make control, you can do whatever you want with that money, here being the computer. So it meets the criteria. So again, whenever you have an employer-employee, you gotta be really careful. And here that $3,000 discount is imputed services. Note though that without the special relationship, just normal everyday arm's length party, if that happened, if this was a discount like a coupon or something, it would be fine. There wouldn't be gross income. Okay, so that's something to understand, is that if you have a coupon or there's a sale going on, let's say that, we change the facts and say that these parties are unrelated and it's Plum buying it from Apple, gets a $5,000 computer for $2,000. Really good deal, right? It's really good. Well, the coupon or discount would not be gross income. It's just simply the $2,000 is what the fair market value is, a willing buyer and willing seller that are unrelated. It's just viewed as that $2,000 is the actual fair market value. So that's how this all fits in. So an employer-employee, we got to worry about implied compensation, which does raise gross income issues. With family members, and by the way, the employer for this transaction, since the employee has to include the $3,000, and by the way, you can't refute this. IRS comes in and says it. I mean, if you could show without any doubt, basically the burden is on Plum and Plum's employer here to show that this is not a, in any way a compensation, that it is arm's length with respect to this transaction. the employer here would get a $3,000 deduction, and again, Plum would have to include the $3,000 as gross income. So $3,000 of gross income is included on Plum's tax return for this amount. So that is the implied compensation with respect to the special relationships. When you have family members, there's an implied gift aspect, and you'll learn more about gifts in later videos. Implied gift aspect. And then if it's owner of a business, okay, and you have some type of corporation, there's all different types of things that go on. Implied dividends, implied contributions, and whatnot. So I hope this helps you understand. Again, the end result here is that Plum has $3,000 of gross income because it's viewed as implied or indirect services that were performed, and that's where that discount came from. Again, Plum and the employer can try to refute this, but they're going to have a really hard presumption to try to refute that, and the IRS comes in and they automatically, they assume that's what happened.